Hello, this is Corner Invest. Today I'll be talking about the greatest monopolies in this market today. So in today's video, we'll be covering a few things. We'll be covering Tesla's earnings, the greatest monopolies in this market, why a high valuation doesn't matter sometimes, as well as some questions that you guys have left in the comments below. So let's talk about the market rally again. So over here, the market has been rallying quite hard recently. Over the past 2 days, we've rallied around 5 to 6% already. And this is because Trump, he basically said that the tariffs on China won't be as high as 154%. It will be down to around 50 to 60% or so to make it more sustainable. But for me, I think the market rallies are unsustainable. When you have a market that is rallying on headline news rather than actual fundamentals, that is a broken bull market. So it will likely retrace soon. Let's see what is going to happen. So we'll be talking about Tesla's earnings first. Tesla reported 20% drop in auto revenue as first quarter results missed Wall Street estimates. So this is Tesla's earnings over here. EPS came in at 27 cents as compared to 39 cents that was estimated. Revenue came in at 19 billion as compared to 21 billion that was estimated as well. So for Tesla over here, the total revenue slipped by around 9%, and then your automotive revenue, they dropped by around 20% or so. So for this company over here, it's quite ironic because normally when a company misses earnings this badly, it will drop in stock price. But for Tesla over here, it's actually rallying because Elon Musk, he basically said that he'll be spending a lot less time on Doge and more time on Tesla. So for Tesla shareholder over here, they are investing in a story. It's never been about the numbers. And basically investing on Elon Musk, the man himself, they're not actually investing in a business. They believe more in the story rather than the actual ongoing business as well. So what they want is your robo-taxi, your Optimus robots and all that, as well as Elon Musk becoming the biggest entrepreneur in this world and continuing to do so. Whereas for me, I think I would prefer to invest in the numbers, the actual business that is ongoing. So I'm not looking to invest in Tesla. I probably never will, maybe just for trade. But for me, there are a few risks associated with Tesla. So there's key man risk. If Elon Musk gets injured or if he gets shot, then this business will go to hell. Normally, I want my businesses to be run by a nobody so that even if that guy is no longer operating the business won't fall. So this is called key man risk over here. Next one is competition. So in the automotive industry, you have companies like Ford, GM, all these different other automotive companies that's competing for the same market share. And then you have BYD in China as well, which is producing a lot better batteries and a lot better self-driving as compared to Tesla. So there's competition as well in that space. And then the last portion is just innovation risk. For Tesla over here, the story for it now is just the robo-taxi. If the robo-taxi story fades, then this company will go to crap. That's it. So I'm not investing in Tesla. I'm not planning to. Hopefully, the Tesla investors, they can continue achieving good returns over time. But let's see how it goes for this one. As for monopolies that will never disappear, these are some of the criteria that I had for my juggernaut. So I want predictable businesses, I want sound management, I want operating leverage whereby the company is able to increase profit margins, increase its gross margins, increase its net income margin over time, and I want minimal competition in the space. So let's talk about the first juggernaut first. So the first juggernaut is ASML. ASML over here is the company that makes these extremely massive lithography machines. So for ASML, this is the monopoly of the business. So it is under the patterning section, which is the most critical portion of this creation of your semiconductor, and it holds the greatest dollar amount as well. So it's around 31 billion. There is nothing else that is matching or nothing else that is maybe slightly close to it other than deposition over here. So for ASML, it is the only company in this wafer fab equipment space that holds more than an 80% market share in their individual segment. So if you're to look at, for example, Applied Material AMAT, it is a company that has market share in a lot of your different spaces, but it doesn't have a dominant market share in one space. So for my companies, I prefer them to have a massive monopoly, and that's why I chose to buy ASML out of all these companies over here. There's another consideration as well, which is TSMC. TSMC, I believe, is a monopoly as well. But for TSMC, the problem with it is situated in Taiwan. So there will always be the Chinese overhang over there, whereby the China government could invade into Taiwan. There's some form of conflict with the US. So that's why I prefer ASML over TSMC. Although TSMC is also another high quality business that I think is extremely monopolistic as well. So for ASML over here, here are some of the tailwinds. So over here on the left is the chart of the semiconductor industry. So the semiconductor industry, it went down in 2023. We had a negative growth year, and then in 2023 it's supposed to be like the pivotal year, followed by 2024 where it's expected to grow and continually grow all the way until 2028. So for ASML, if you're to look at the fundamentals as well, 2024 was that turnaround year, and this year they're expected to grow revenue by around 15 to 20% or so, and EPS EPS at around the same rate as well. I believe it's around 20% for the EPS based on the analyst estimates. So for ASML over here, you have a company that's trading at 26 times earnings, expected to grow at around 20% this year. I think the valuation is more than reasonable. And another tailwind for ASML is just AI. So for all your different LLMs, they require data center, and the data center require the chips, the high-end chips, which are made through your different fabs. So for TSMC over here, TSMC are promising $100 billion investment into the US to create more fabrication plants and more manufacturing facilities and all that. So this is likely a tailwind for ASML, because if TSMC is going to come into the US to build more fabs, then likely they need more lithography machines. And the lithography machines can only come from a single company, which is ASML. That's why I think ASML is one of the biggest beneficiary for this investment over here. As for ASML's valuation, I have the bear case, the base case, as well as the bull case. The bear case is, this is based on a 2025 estimate, which is this year. So the current stock price now is at around $650, and based on the base case estimate, the fair value is around $753. So it is around a 13% undervalue right now. It's similar for the 2030 guidance, where I use the mid case, the low case, as well as the high end. I got a base case of around $770 based on its current stock price. So similar story, it is around 15% undervalued right now. I think the valuation makes a lot of sense if you were to look into investing in this company right now. So this is a high quality business that I'm likely going to hold over the next few years. And let's see where this one goes. Next monopoly is Visa and MasterCard. So for Visa and MasterCard over here, I think they're one of the highest quality businesses in this entire world. In fact, I'll put them in the top 3 or top 5. So for Visa and MasterCard over here, you must be wondering what this thing is. Visa and MasterCard are simply just the toll gate. So what they do is they just stand here, and then they just act as payment processors. They don't do anything. They don't acquire customers. They don't have to go and issue debt. All they do is they just stand there. People pass them money, and they act as the middleman, and then they pass it on. So for Visa and MasterCard over here, they have incredible fundamentals. So if you're to just look at the revenue growth, for example, Visa is growing at around 10% every single year, and you add that with the share buybacks that they have every single year, which is around a 2 to 3%, that is easily a 12 to 13% EPS growth already for Visa. It's a similar story for MasterCard. So MasterCard is having around 12 to 15% in terms of its revenue growth. So 12 to 15% of revenue growth plus around 3% of buybacks, that is around a 15 to 17% EPS growth for MasterCard as well already. So Visa and MasterCard, 13-15% growth is extremely doable. So that's why I think these two companies are extremely high quality businesses that you can look into adding into your portfolio today. The third juggernaut is Berkshire. So Berkshire Hathaway is one of the best companies, one of the best performing companies in the S&P 500. So this is Berkshire's stock performance over the past 30 years, 40 years or so. So Berkshire from 1965 until 2024 has achieved a compounded annual growth rate of around 19.9%, whereas the S&P 500 has produced around a 10.4%. So the valuation right now is at around a 24 times operating income. So it's not extremely cheap right now. But for the quality of this business, I think this business is just built to survive over the next 10, 20 years or so, even if Warren Buffett is no longer around in 10, 20 years or so. So for Berkshire over here, if you're to just look at the fundamentals itself, this company has grown operating earnings by around 27%. So although everyone thinks it's a boring business, this business is just extremely high quality. I mean, it's built to last forever. So Berkshire is a boring business, but it's an incredible stock to own. There's your Warren Buffett image that you will always have even after he steps down from CEO. People doubt him time and time again, but he has always beaten the market. So this year alone, Berkshire Hathaway is up around 15%, whereas the S&P 500 is down around 8% or so. So that is a 23% outperformance by Berkshire simply in this year alone. So again, people doubt Warren Buffett, but he's truly the greatest investor of our lifetime. So these are some of the notable buys that Warren Buffett has made in the past few quarters or so. So the first company over here that I find extremely interesting is VeriSign. VeriSign, it is a monopoly in your .com domains. Basically what they do is they sell all the different .com domains. So every single website that requires a .com domain has to go through VeriSign. They are the only licensed seller of these .com domains because they have to sign a contract with another organization called ICANN, and only VeriSign is able to sell all these different .com domains. So this company over here, I find it extremely interesting. I was looking into it at one point, but I didn't enter it. Now it's trading at around 30 times earnings. I think it is slightly overvalued now, but hopefully it gets lower someday so that I can buy into this extremely monopolistic and high quality business. Next one is SiriusXM. So SiriusXM, it is a monopoly in your car radio providing space. So although it's a sunset industry already, it is a monopoly. Every single car, including your Tesla cars, has some sort of SiriusXM radio installed inside. Last one is Pool Corp. So Pool Corp is a monopoly in your pool space. So all your different pools in the US, if you were to install your pools, you need to go through Pool Corp. If you were to clean your pools, you need to buy your stuff from Pool Corp. Every single pool appliance, every single pool equipment that you need to get to service your pool, to manufacture your pools, to install your pools, you have to get it through Pool Corp. That's why Warren Buffett has invested as well. It's a monopoly. I don't think it's extremely cheap yet right now, but it is definitely a high quality business. So next portion over here, I'll be talking about why a high valuation doesn't matter for high quality firms. So this thing over here is from Credit Suisse. It is talking about the relationship between your ROIC, your earnings growth, as well as your PE ratio. So as you can see over here, when your ROIC is extremely high, around the 24% over here, if your earnings growth is high as well, you can have a PE of as high as 25 times and still be considered cheap. So let's look at this video over here. The video over here is by Terry Smith. He's talking about why ROIC is so important.
High returns on capital. Why is this important? Companies are just like us. People will overcomplicate analysis. Companies have a cost of capital and a return on capital. If they make a return above their cost of capital consistently, then the value of the company grows over time. If they make a return below their cost of capital consistently, the value shrinks over time. Think of it in personal terms. If you go out to your bank and borrow money at 5% and you invested in funds for the last decade at 18%, you would have become more wealthy. Right? If you borrowed from your bank at 5% and invested in somebody else's fund at 2% return, you would have become poorer. This is not, we don't need to get into higher mathematics here or any particularly sophisticated level of thinking. It's a fact. This is the case. Yet, since Warren Buffett wrote that in his annual report in 1979, I would say more people in the investment community have ignored it than have used it. Basically, take us on, comment, please. This quote from Warren Buffett's number 2, Charlie Munger, in many respects summarizes why this is important. So, I think I'll give a similar explanation. Here's a slightly lengthier explanation. I don't know why he chooses this time period or these particular rates, but it doesn't matter. I'll just read it. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it returns. If the business earns 6% on capital over 40 years, and you hold it for that 40 years, you're not going to make much difference to a 6% return. Here's the punchline. Even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. He's telling us something here, which is very important. This is not a theory. He's not putting forward a theory of investment. It's a mathematical fact. It's important to realize that. And what he's telling you here is something like this. I wish I had a diary that I kept from when I started in finance all those years ago, and I put 2 columns in each day. And every time in the investment business, somebody asked me whether a company or a strategy was high quality, good, had high returns on capital, I put a tick in one column. And every time they said, but is it cheap or expensive, I put a tick in that column. I would have far, far more ticks in the is it cheap or expensive column. People spend almost their entire effort thinking about whether something's cheap or expensive, or highly rated or lowly rated, which I guess is a better way of expressing it, and far too little deciding whether it's a high-grade business that they really want to own that can compound it back. And I think Munger basically encapsulates why it's important in that way.
So this is the formula that I've used to calculate a justified P ratio for a company. So your P ratio is your ROIC minus your growth rate divided by your discount rate minus your growth rate times your ROIC. So yeah, these are some of the metrics over here. You can try and look through it and then just calculate it for some of your companies as well. I'll be doing an example on Google right now. So this is Google's ROIC. Google's ROIC is at around a 33%. If let's say the growth rate over the next 5 years is around an 8% in terms of its revenue growth, and assuming a discount rate of 11%, the justified PE for Google is at around 25 times. So just looking at the numbers itself, Google is currently trading now at a 19 times earnings, and a 25 times earnings is around a 20 to 30% multiple expansion from there. So this company over here, it looks undervalued. If you were to lower the discount rate to around 10%, that is a 35 times PE over here. So next portion over here, I'll be answering some of the questions that you guys have left in the comment section. So first comment over here, for companies outside of the Mac 7, could you provide more coverage on ASML and include GPN? Thank you. So for ASML, I've talked about it earlier already. It is a high quality business that I'm looking to hold for the next few years or so, unless there is some sort of immediate threat to its monopoly, which I don't think will come out in the foreseeable future. So GPN, I haven't looked too much into it yet, but based on the valuation itself, I think this company is extremely cheap. But the problem with the company itself, based on just the fundamentals, is just its debt. So if you have to look at the interest coverage ratio for GPN, basically the net income divided by the interest payments, it is around 5 to 6 times. So normally you want your companies to have at least a 10 times interest coverage ratio unless it's a REIT. But for GPN over here, it is highly leveraged. They have too much debt, and the debt is eating to its margins because it's having to pay high interest on its debt over the past few years or so when interest rates are extremely high. And that's why you're seeing the stocks fundamentals going down and going up as interest rate changes. For me, I don't like investing in companies that are highly levered. I think fundamentally, if you have a highly leveraged business, interest rates will definitely affect the business, and that's why I usually avoid those. Next one, thanks for your insights. How about Palantir? So I saw a teacher from NYU, his name is Aswaf Damodaran. He has basically said that he is interested in buying into Palantir, although the valuation is extremely high right now. In fact, he put in a limit order to try and buy Palantir in this drop, and then they didn't hit that limit order. I would assume his limit order is around $60 or so for Palantir. So for Palantir over here, for me, I think the business is it's a bit too hard for me to understand, and the valuation is simply just too high. It doesn't really make sense at this point. So it's a company that's trading at around a 400 times price to earnings. So if you're a value investor, I don't think Palantir is a buy at all today. You can't have a company that's trading at 400 times earnings and justify that valuation. It simply doesn't make sense. So for me, I think Palantir it's an avoid. Last one. Do you hold any ETFs? Could you make a video on them? So ETFs, two ETFs. One ETF is CSPX. So CSPX is the S&P 500 basically situated in the UK. And if you are a resident situated outside of the US, then you will have a 30% withholding tax if you buy the S&P 500 on all your different dividends. Whereas in the UK, which is your CSPX, the dividend withholding tax is much lower. So you can buy the CSPX instead of the S&P 500 in the US and have a lower cost ratio and all that if you're to buy the CSPX instead. Next one is SCHG. It's sort of like growth ETFs. What they do every single quarter is they will filter out all the different companies based on their different metrics, and they'll filter out the bad companies for you, and then they include the new companies for you. So it is quite an actively managed ETF that has been doing well over the past few years. So if you want growth, you can invest into SCHG, and it has a lower expense ratio as compared to your QQQ as well. So two ETFs, SCHG as well as CSPX. Hope you guys have found this one useful and invest safe.